Many people have recently increasingly been offering opinions on swap dealers and their massive short position. Some are noting the size, some predicting Armageddon for banks, some even betting that history will repeat, the market will regress to the mean, and the swap dealers will win against the funds.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, I'm Vince Lanci. Today we will be doing a breakdown on swap dealer risk and roles on this program. Swap dealers are unhedged bookies now, tentatively the title. We'll also be going through the margin requirements that were raised for the day. But first, let's start with the markets. The dollar is down 6, 100.50, US 10 years 377, down 2, S&P 500 is 57.51, up 5. The VIX is 1544, unchanged bid. Gold is down 8 and change at 26.63. Silver is 31.97, down 3 cents. Both have been offered lower overnight. Copper is 458. Down 3 cents, gold, silver, 83.27 at a crucial level, I think. WTI, 68.66, up 25 after getting destroyed yesterday. Natural gas, 249, up 2 cents. Bitcoin, 65,449, up 294. Moving with stocks and gold simultaneously. Ethereum, 26.52. The beach ball seems to be bouncing now. Palladium, 10.30, down 17. Platinum, 10.17, up 7. We're going to be doing something on Palladium this weekend. We're going to be elaborating on what we're discussing here this weekend, and we have some special content pertaining to Michael Hartnett's report. Grains, you can see those. Let's get right to it. Okay. First, the quick note, the news. Gold and silver margins were raised by COMEX last night. This is intended to dampen speculative volatility. Quoting ourselves here, COMEX raises margins, GC to 11K and 10.5 for silver to 11.5K from 11K. No real shorts left to cover. Now nibbling away at the return on investment for newer entrants. Room for more hikes, sure, for sure, right? There's the data. Next, swap dealers. I'm going to leave. I have 3 charts for you to see here. 1, 2, 3. Lots of notes. We'll try and keep this cursory for now. Many people have recently increasingly been offering opinions on swap dealers and their massive short position. Some are noting the size, some predicting Armageddon for banks, some even betting that history will repeat, the market will regress to the mean, and the swap dealers will win against the funds. This will help understand the dynamic better. All 3 types have some points, but I think many would benefit from this. So the following outline is from experience as counterpart, competitor, co-conspirator, and participant in the gold and silver derivative OTC and exchange markets in London, US, and Singapore. Parts of this were used in background on civil cases and gold manipulation, which, by the way, exist in any way you define the word. Okay, let's move on to the outline, just to give you some broad strokes. The analogy we're going to use today is bookies and whales. Swap dealers, by that I mean bank, not all swap dealers. Bullion bank swap dealers are bookies. Their clients are gamblers. Bookies have what we call the 3C advantage. They have captive clients, cash, and credit. This is a term I've used for years. Banks keep their clients captive many ways, and they have more cash than almost everyone. And they have lines of credit, whether it be with the Fed or with other relationships to facilitate those positions. Clients have the 3 T's sometimes, which is really the only way to defeat the 3C advantage. So clients have trading. They presumably know how to trade better. Training, they have been trained in a far more disciplined and focused fashion. And technology, they are using the latest technology. So that analogy can be broken down into bullion banks being the aircraft carrier and trading firms being the small boat that can swim circles around them. Now, bookies enjoy massive asymmetric information advantage depending on the size of their captive client order flow. In metals, the most reliable client to have for the last 30 years has been the producer segment. That's a subsegment of the commercial segment. Producers are historically far bigger, far more regular, and offer more information flow than any other segment or subsegment of the industry, and the banks love them as a result of that. Now, the producer has been the whale client for the bookie for 30 years. This chart you're looking at here, that is the FinViz chart. The red line is the speculative longs, or this net speculative longs, and the green line below is the commercial hedgers. Hedgers should be in quote. Commercial hedgers is comprised of two main components: industry players, we're going to say net it's producers, and bank swap dealers. If you were to divide that out, you would see a remarkable difference between the numbers over the years. And we're going to do a cursory version of that for you right now. Bookies are directionally biased based on the lopsidedness of their order book and will do anything they can to make money off of that bias. Whales, the producer clients, are hedge sellers hedging production, and they have decreased their participation in hedging activities remarkably, or markedly, I should say, over the past few years, and we will show that in a second. The conclusion from the lack of producer hedging is one of four things that we've identified. Either whales are not hedging, someone is directly buying from them, they have already hedged, or they are running out of metal to hedge. Assume it's a combination of all four. This is what we mean when we have said in the past many times that there is less organic selling. There's less selling from the producers. So what happens to a bookie who has a bias because every time he comes into work, there's a producer giving him some to sell or selling to him? What happens when that producer stops selling and the bookie has a legacy position that he's constantly massaging? Well, the bookie must hold on to a bigger and bigger percentage of his short position for longer and longer duration. The Super Bowl is approaching. It's the Cowboys versus the Eagles. Can't be the Cowboys versus the Eagles, but let's pretend that it is, because those are the two teams that I pay attention to the most. If you're a bookie and you're in Texas, you're going to be handling a lot more Cowboys buying orders and a lot more Eagles selling orders. What happens if you can't lay off that risk? Well, you end up carrying a lopsided book, and you become vulnerable if a new whale comes into the market. So what happens when a new whale comes into the market? Well, when a new whale comes into the market, this picture is semi-related. When a new whale enters the market, one that is not a natural seller, one that is a natural buyer like a central bank, the bookie blows up. Not immediately. Before he does, he maxes his credit. That's one of the C's. He uses all his cash. That's another of the C's. And he milks his private captive clients to sell more to him or for him. He calls his bigger pals to help him out and starts doing everything he can to survive. What do we mean by blow up? Traders get told liquidation only, then they get fired. Bullion operations get downsized at smaller banks. Bigger banks take a hit maybe, but end up taking more market share and court the new whale. The biggest banks end up being the biggest profit makers when the market does regress to the mean. All right. So the bigger bank also ends up finding out who the big buy whale is and ends up having them become a client. Now, there's a lot more to get into here, but I just want to just graphically sum this up for you. This chart I showed yesterday, it's marked up a little bit. The two blue lines are all we care about here. The blue line on the left are producers and end users. What it really means is people in the business of mining, refining, and selling gold. And that business in the hedging industry is dominated by producers who hedge their production. The reasons for that I have listed, and we'll get into that some other time. The other blue line are swap dealers. Now, these are looked at like two separate entities. That's a mistake. They are separate, but it's a mistake to look at them as two separate entities behaviorally. And as a result, they get lumped in under commercial hedgers. Swap dealers are not commercial hedgers. Swap dealers take the other side of producers. When producers wish to sell, it's swap dealers that buy from them. And so when swap dealers have a big client, a whale, who's constantly selling, they tend to front run the client. They tend to hit the bids quicker. They tend to go home short gold because they know tomorrow at noon, their producer will be back to sell some to them or into the market, driving it lower. Now, that's the background. These two have a relationship. The whale is the producer. The bookie is a swap dealer. The swap dealer has a bias based on how big his producer business is. However, if you look from 2007, the red line, to 2024, producers have pretty much, with some volatility, remained where they are in terms of their shortness. However, during this time, from '07 to 24, swap dealers have gotten much more genetically short. Now, why have they gotten short? This is not a panic. They've gotten shorter because the market has grown and more buying has come in. They have been forced to take the opposite side. You remember this picture here. They have been forced to take the opposite side of a growing cohort, and that cohort is investment and trading and central bank buy interest. So they've gotten short, and that's their business model, and they will lose money from that from time to time, but they bet on a regression to the mean. Now, the green line, in my opinion, is far more interesting. Between 2017, I have it marked approximately June 2017 to June of 2024, the producers have taken a turn to under hedging. Okay. It's still a producer whale. He's just not selling as much, which goes to my point about why are they hedging much? Now, the green line on the right is a swap dealer who's getting much, much shorter. So the result is the blue histogram is what we're looking at here. The result is that the commercial short to long ratio has increased commensurate with the commercial long, with the non-commercial long ratio, but the mix has gone from being, let's say, 50-50 producers and bookies, or let's put it this way, producers and swap dealers who front run their own clients, to producers 20% and bookies 80%, still hoping the producers sell to them. Now, what will happen? What will happen is invariably we will regress to the mean, but there's no illusion here. You know, when the market rallies $50 3 days after the Commitment of Traders report last week says that the bullion banks got short, whatever the number is, 20,000 contracts, they're losing money. $1 billion here, $1 billion there. They're not marking it to market. They're not showing it on their earnings, and their risk management is stomaching it. But until those funds get out, these guys have unmarked losses on their books. And eventually, risk managers get tired of it. And eventually, they close their risk out or fire the trader for having the risk. So there's a lot more to this. Unfortunately, time is not permitting me to get into it. But the bottom line is swap dealers are bookies. Their positions reflect the bias they have from their biggest clients, which are producers. And those producers are the whale client they prepare for. I see the producers coming up the driveway. Let me sell some because when he gets here, I know he's going to sell to me. That's how it works. However, the dynamic has changed. The swap dealers in their little bubble still see all the producer flow, but it's shrinking. But there's another whale in the Shanghai exchange. There's another whale, OTC, that they're dealing with. And that whale is calling up and saying, I'm going to buy every time I call you for the next 6 years. And those are central banks and Chinese traders. And the bullion banks are now having to digest a shift. A bigger whale is coming in while their biggest whale is hedging less. And they're being forced to take down a bigger market share. Now, in the end, it'll be the JP Morgans of the world that remain short, and they may not even be profitable from this. But swap dealing is a part of a bigger business for them. They negotiate for physical. They have conversations with Xi. They take these companies public. Okay, so that's it for now. You can see the market's down 6. Have a great day.
Thanks for watching this morning's Markets and Metals with Vince Lanci, brought to you each day by Miles Franklin Precious Metals, where this week's specials include 2024 American Silver Eagles for only $5.25 over spot, and 1 ounce gold Argo Heraeus Dragon bars for only $69 over spot while supplies last. Find out more, send us an email at arcadia@milesfranklin.com or call us at 833-326-4653. And as always, thanks for watching. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.